Hi, I'm Nigel Baker, and you're listening to The Future Financial Advisor. We're running this podcast to create an avenue for advisors to share their thoughts and their best interests, and really trying to attract those advisors who want to take the industry forward. What we want is great businesses who are really making a difference and really making a big impact to their clients, and we want to know how they're doing it. So in this series, we're going to be discussing the latest digital platforms, some best practices, evidence-based investing strategies. We want to give financial advisors the tools they need to help more investors improve their financial well-being. So if you're ready to take the industry forward, modernise your advisory practice and reach a new generation of investors and the new generation of advisors, then this show is for you.
So all our recordings and podcasts are general advice. All the content, all the people interviewing here, it's all their own opinions and all their own views. In no way does it constitute any personal advice or recommendations. If you need specific advice, please go and seek an advisor. Thanks very much.
Hi, and welcome to today's version of the Future Financial Advisor. We're talking to you here from Sydney, Australia, and today I'm really excited to interview Patrick Anwandter. Now, Patrick is the Managing Director and representative of a fantastic financial advice firm called Strategy First Financial Planning. They're based in Sydney. Patrick's got a lot of experience. You're going to learn a lot from his interview today, I'm sure. He's been ranked as one of the top 50 financial advisors in Australia by Barron's. He's a finalist at the IFA Excellence Awards. He's been ranked in the top 50 of the AFR Smart Investor magazine Masterclass for 7 years. He's got 20 years of experience, particular expertise in SMSF, wealth accumulation and strategic planning. It's really great to have Patrick on board today. Part of the purpose of the Future Financial Advisor is to speak to great advisors so you can learn from their experiences and how they've built great practices and how they're thinking about the future. So with our digital service, ntm.com.au, you can connect with other advisors like Patrick and learn how to bring digital practices into your services, and also learn how you can help many, perhaps millions, maybe thousands, rather than a lucky few. Thanks for listening in. Hi, Patrick, and welcome to today's podcast. Great to have you on board.
Good to be here.
Yeah, so first and foremost, the question I like to ask is, tell me about your story.
Yeah, so personally, I've always had an interest in finance, since I was a teenager. Yeah. I've been in the industry for about 30 odd years, and I realised I shouldn't have done the maths in terms of how many years, because it just makes me feel old.
Can't be 30 years, can
it? Close to it, I think. I think it was mid-90s.
Yeah. I didn't think you were that old either.
Thank you. I'll pay you later. So I've always had that interest in finance. Yeah. My dad put me into a dodgy investment, platinum, back when the price was, I think, too high.
Yeah.
When I was a kid, but I kind of fell into financial planning, not really knowing anything about it.
Yeah.
At uni, we didn't do anything about finance or super or tax. Fell into it by accident, and was working through a number of different firms, from larger banking-based financial planning, and then down to self-licensed firms before Strategy First.
Yep.
And I saw a lot of the industry, saw a lot of the problems back in the old days, with product-based focus. And we moved to that self-licensed firm. And that's where I met my business partner, David Price.
Yep.
Obviously, he wasn't my business partner back then.
Yep.
Through that whole period, I guess through the exposure to clients, we really started to see the absolute benefit to clients, not from an investment or portfolio perspective, but really about the outcomes that we can help clients achieve, which is critical to to their well-being. And at that time, David and I really became a bit frustrated with a couple of key issues in the industry. One was the fact that the way we charge fees, commissions and other incentive-based payments, which meant that the industry was typically focused on selling a product, as opposed to putting the client first.
Yeah.
The other part was about the investment process. A lot of active management, picking stocks, picking funds, a lot of ego involved with that. And we kind of got sick of having to apologise for underperformance. So David was the founding director of Strategy First.
Yep.
And I joined him very shortly afterwards. And through the last almost 17 years, we've been building up the firm, focusing on having a great culture, our values, which is about making clients' lives better, but also really making the lives of our teammates better. And it was almost exactly a year ago that we hit the independence milestone, which is important to us. It took a lot of work, but it's just for us another example of our core foundation of who we are and what we stand for. So it's been a very interesting journey. There's been a lot of changes going on.
Well done. I mean, for those listening, I mean, you guys are really pioneers of building that real, I suppose, values-based advice business back when people were very product-focused, and you didn't have to. I mean, there was no regulation saying you had to turn off the commissions.
No.
You did it because you saw that you wanted to help clients and felt that was a better way to do it, which is just amazing, right? And that was a brave decision back then, because it was probably more beneficial perhaps to take to you guys in the business in the short term to take on the commissions and earn more money short term, right?
I mean, a quick example, so we started in 2005. So it was about 2007 before the GFC started to hit.
Yeah.
We were approached by one of the providers of hedge funds, which you go into as a structured product with capital protection, backed by a loan from one of the investment banks.
Yep.
And we were offered commissions based on the product, the loan, and then if we sold a certain amount of product before May 31 that year, 2007, we could get a bonus commission. And we worked out as effectively a startup firm that we could generate probably about $1 million worth of commission.
Wow,
and we said no.
Yeah.
That product then fell over during the GFC. The capital protection did work, but the clients we didn't put any clients in it, but we inherited a few clients who did go into it, and they were stuck with a product which was capital protected, but they were paying this interest, a very high rate of interest.
Yeah.
And it didn't make sense to us, and it conflicted with our values, so we just didn't go into it. Yeah. And I think that, thankfully, that was a smart choice.
Yeah, absolutely. I've got similar stories of being in a big accounting group at the time, and I was getting also almost in a bit of trouble, so to speak, from the group for not using commission products like forestry and the like at the time. And we didn't use them, and then the GFC hit, and a lot of those firms that did got in a lot of trouble.
Yeah.
But to me too, it just didn't make sense. Yeah, we could have made some short-term money, but it wasn't the right thing for the client. So again, I think your story and building up a great business now. So your business today, how many staff have you got, and roughly how big is it?
Yeah, so we've now got 18 staff, including myself.
Yep.
I've been stepping back as an advisor, focusing more on my role as MD, which is important because, as I said, part of our value, our purpose is to make lives better, not just for the clients, but for the team and even for the shareholders.
Yep.
And so I think that if I can give my staff a great environment in which to work their best, they'll look after the clients. Yeah. Right. So so 18 staff, currently about 350 ongoing service clients, and looking after probably in excess of $700 million.
Yeah, fantastic. Yeah. Well done. It's a great story. And as I said, for those listening, to be able to tap into your story and learn how to, if they're just going down this journey or starting out in the industry or looking to convert their business, then you wouldn't be a bad guy to speak to.
Happy to.
So looking forward, what do you think some of the key issues facing the industry? And we've been through all these changes, but what do you think now? Where do you think the advice industry needs to go in the next 5-10 years?
Yeah. So when you look at where we've come from, one of the key issues I think is the ongoing, I'll call it a burden of regulation and compliance. Now, compliance is not necessarily a bad thing, but we all know, especially as advisors trying to do the best thing for our clients, that compared to sitting with a client for the first time and knowing what the client needs to do, but you can't tell them that, you've got to go through the process of an SOA and everything else, it creates friction. However, compliance has a purpose as well. And it's not just about protecting the clients, it's about making sure that what we do, fundamentally is for the client's best interest. Now, how the compliance actually applies or needs to be applied can be a bit burdensome, and therefore what that does, it increases the cost of giving advice. So trying to find the right balance between being compliant, whatever that looks like, because it's a scale in a sense, but being able to efficiently and effectively look after a whole range of clients. As ASIC have looked at, trying to ensure that clients' advice is accessible to a broad range of clients, not just those who can afford to pay it.
Yeah, absolutely.
Yeah, so it's that's a key part of it for us. I think we've got a pretty strong culture of compliance, and I know that it does create some conflict within the firm sometimes. But I think once we understand the spirit of a lot of that legislation, then it creates a high level of engagement with that compliance aspect. It's not going away. I think there's a broad view that the pendulum of our ultra high compliance introduction, if you look at October last year, for example, hopefully we'll start to swing back to a more balanced approach where we don't get significant changes for a while. Fingers crossed. The next big change, which I think relates to this, is just the dwindling number of advisors. I think we're down to about 17,000 or so. The demand for advice is not going down. The cost of going advice is not going down either. So whilst it might be a great market to be in from that supply-demand equation, I think it's just not going to serve clients well.
Yeah.
I think the number of good advisors leaving the industry is going to create a problem. And for a couple of reasons. One, we know that a lot of these, for example, the education standards coming in are designed to get us to a profession. But if you think about the experienced advisors who are looking at that thinking, I can either go back to uni or I can just leave now and the market's looking pretty good as a seller. We've got some great people leaving the industry, and not just the impact directly on clients. It's also the next generation of advisors coming through who could really take advantage of that mentorship, that experience. And they're not going to get access to that. Right. So if there was some way that you could, tap into that experience, make it worthwhile for those departing advisors. We've got one of our senior power planners. She's been in the industry for I think longer than I have. She got out of directly giving advice for a number of different reasons, not excluding the education standards. But she wanted to, in inverted commas, give back. And so she is not only a senior power planner, but she looks at her role in the firm as really mentoring the younger guys coming through. So I think that's fantastic. And if we can somehow encourage and motivate the good advisors who are looking to leave to continue to stay in and provide that kind of input, it would be fantastic.
Yeah, absolutely. It's a good idea.
And I think I look at three key issues. The other one is technology. We used to look at technology as a threat in terms of robo advice, but I think we all realise now, hopefully, that that's not a threat. Technology is not going away and can actually be a fantastic enabler for making advice more accessible to clients. And I don't mean just reducing the cost. I'm just talking about actually getting a client to engage with their advice. If you think about what advice basically is change management. We're asking a client to change the behaviour. So when you look at giving an SOA, an 80-page SOA, for example, as a paper document, clients don't engage with that.
Absolutely.
And you look at technology, and some people, hopefully fewer now, think that technology means converting that document to a PDF and emailing that, right?
It's a start.
It's a start, but that's kind of 2010, I think. But, I think it can actually really make access to that advice more engaging and help us keep the clients more accountable to what they've got to do to help them achieve their objectives.
Yeah, absolutely. So I think we're seeing that. We're seeing the industry start to shift to more client experience rather than perhaps where technology might have been being used for practices to be more efficient or for more product or whatever. But now they're saying, actually, how does this technology help the client stay on track or understand their goals or understand this better? So you're using a bit of technology in your practice. Obviously, if you've been around a while now. You're around when I'm in my first job. It was in the job ad if you got a PC or not. That was like a selling point.
And then Microsoft Office skills.
So you would have seen a bit of change, but right now, how are you starting to use more technology in your practice?
Yeah, it's a good and I guess relevant question because it is such an embedded part of our process. And you must have seen kind of my ideas that I was going to talk about in the sense that I look at technology, through three key lenses. One is about that client experience that you mentioned. As I said, the back office efficiency is important, but it's really about driving that efficient the client experience and getting that engagement. So if you think about a lot of the pathways a client goes through, from what we call onboarding, review, SOA, and then even offboarding. You look at all the friction points that a client faces. The capturing all that initial data, the fact-finding process is inherently full of friction. And that's where you lose a lot of potential clients, I think. So using technology, so we use microspirity, for example, as a key part of that onboarding process. It is still a fact find, so to speak, but it just allows the data to be captured directly into the portal within microspirity, which can then feed into the core program we use, which is Xplan. So having that direct integration works pretty well. But then we also, from the client experience perspective, really try to drive that engagement by using more dynamic client-facing documents. So we use a platform called Quilla, which is really good because you can then embed different elements within it. So, for example, we use Loom videos a lot for our clients. And that's fantastic. And the feedback we've had is really good. And two reasons being, one is that you're personalising the advice. So instead of having your SOA either templated from compliance team or the advisor or power planner, redrafting things, and they're writing a document in a relatively formal fashion. by being able to have, say Nigel, talking to a client on their video, maybe even specifically about the client's advice.
Yeah. Wow, that's good. Yeah.
You're talking to the client in your words.
Yeah.
And then you have all the analytics behind it, so you can actually see where the client's maybe gone back to, minute 2 on the video about super, for example, and you can actually say, well, the client's actually got some questions there.
Yeah.
Maybe they're not asking them yet.
Yeah.
But it's a really powerful tool, a powerful way to drive that engagement.
Yeah, fantastic. So you embed that into a document, I guess.
Yeah.
So I might say, here's strategy 2 and here's a little video and then a few words or whatever. Yeah.
Exactly right.
Yeah, cool.
Yeah. And the second lens is about that efficiency.
Yep.
Right. So, when we look at any kind of new tech, we kind of try to answer a few different questions. Is it going to enhance client engagement or the client experience?
Yep.
Maybe at the cost or at least at no benefit of back office?
Yep.
Or is it going to enhance the back office process? And what effect does that have on the client experience?
Yep.
And ideally, we want to get a win-win.
Yep.
Like it does both.
Yeah.
And we've employed a few different technologies, even with some of the investment platforms with automatic rebalancing of portfolios.
Yeah, right. Yeah.
It's not an SMA or an MDA, so we're not actually taking any, we're not getting a direct benefit out of it.
Yep.
But the client gets a more automated process for their portfolios being rebalanced, particularly at kind of real turning points in markets.
Yep. Yeah.
But it allows us then to really focus on the broader picture of the client's overall situation, making sure that they're on track in terms of all the strategic issues going on.
Yeah.
And the third lens is about compliance.
Yep.
Okay, so compliance, as alluded to before, is not necessarily a bad thing, but you also don't want it to be the end of process, checkbox process area. We want to really embed compliance into the process so it's almost hidden. The guys don't realize they're being compliant.
Yep.
Now, if you think back, 20 odd years ago or 15 years ago or so, this is a really simple example, but the idea that an SOA, for example, must include the title of statement of advice. Now, you could give the guys, the power planners, a blank Word doc and say, complete an SOA, make sure you type in statement of advice, or you have a template, which has all those key elements in there. And it's a very simple example of how you can embed that compliance into the process.
Yep.
So we try to do that more and more. So, into the workflow, especially for onboarding clients, get FSGs out almost automatically. Making sure that, again, that FSG is then logged into, say, Xplan.
Yep.
And we use a reg tech platform called SAMI.
Right.
Which means...
SAMI?
SAMI, yeah.
Okay, yeah.
It's really good because it allows us to very efficiently audit pretty much every SOA that goes out.
Yeah, fantastic.
So rather than having an annual SOA audit...
You have to catch up later. Yeah.
It's actually it's a fantastic pre-vet process.
Yeah.
Which picks up a lot of the key compliance issues about risk profiles have been discussed, have fees been disclosed, the statement that the client's going to be better off being articulated.
Yeah, brilliant.
Yeah,
there's some great ideas there. I mean, there's some. If you're listening in, I mean, some of those ideas there, we'll put them into the notes as well. But I'm learning as you're speaking as well, and we've spoken a bit in the last couple of months. So there's always little bits and pieces here. I'm sure practices are going, wow, how do we nail some of this again? How do you just make the client experience better rather than just focusing? You talk to some advisors and they're so bogged down in the compliance thing, it just becomes too hard. Yeah, but I think they're just not flipping their mindset, saying just use it to make your practice better because you don't have to get lost in this. Yeah,
and another simple example is just recent. So we use HubSpot as a CRM.
Yep.
And we're still learning how to use that properly.
Yeah. Same here. So there's a lot to learn, but it's pretty good.
Yeah. And one of the things that we found as a legacy of, especially our use of Xplan, is that putting in client data, especially when you're manually entering the data and then manually entering it again into another platform, it's ripe for error.
Yeah.
And a simple example is one client, his first name was typed in with a space at the end of it.
Yeah.
And then when you try to manipulate that data, it just becomes really difficult.
Yeah.
So what we did with HubSpot, we created a form that it lives on our website.
Yep.
And client will direct the client to that form. Very simple, 3 quick key questions about their name as it appears in their license, phone number and email. Okay, but then we then went further and created a QR code where, if you're sitting down with a client prospect in the cafe, for example, and we go, Nigel, I want to arrange a meeting or I want to get in contact, you can get out your phone, have the QR code, they can scan that, takes their phone to the form, they can complete it straight away, creates a contact in HubSpot, which we then feed into the other platforms.
And then you've got that data right forever.
And it's correct, assuming the client enters their data correctly.
Relying on them. But hopefully they know how to spell their name.
Hopefully,
That's brilliant. That probably touches on to, some of the technology you're using for your review process. So some of the practices, and I remember back in the day, we'd have a review process and every month we'd literally send out like a letter with 10 pages of information and And one day we turned around and said, wonder if we ask our clients if they actually get any value out of this? And about 1% said, yeah, I actually get this and read every page of it. And it was taking the practice hours and hours and hours every week to get all these documents out and check them all.
Yeah.
So in terms of, again, your experience over the years and what you're doing now, what are you doing in terms of servicing those clients and how you, and it's probably touching on to this client experience aspect as well, and how to use technology, how are you doing that now, and what sort of improvements are you looking at to improve that experience for clients?
Yeah, it's a really important question that we've been internally looking at for the last few years. So I'd like to think a lot of the industry was focused on reviewing client portfolios.
Yeah.
Because we're looking after their capital. It's important to the client. They see those metrics pretty easily.
Yep.
And with the manual process of implementing any changes, it absorbed 70-80% of our review time with clients, which meant that the more important issues weren't given the right time or the right exposure. The strategic issues, how the client's tracking to their objectives. Being fee for service since day one allowed us to actually do that, especially for smaller clients from a portfolio perspective. So we could sit down with them and go through and almost produce a new SOA. But again, as we know, especially back in the day, that process of capturing the client data was just really, really cumbersome. With that platform auto rebalancing approach, it effectively frees us up to just focus on the client's broader situation. So we've developed what we've kind of coined as an agile SOA. It's still a work in progress. What that does, using the technology that we have, if we can simplify, and we are simplifying the capture of that client information, so not asking a client to complete a new blank fact find every year, for example, because we should know a lot of that information. Just getting them to check to make sure things like their salary or even their objectives remain consistent, and then producing this SOA document again with the videos and everything else, and just covering off the key components of that advice. So we've been able to effectively expand that broader review process, covering the things that are actually important to the client, and do that in a way that's a lot more efficient than that initial SOA process.
Really good. Actually, I had a session last week, and there was an external speaker who wasn't in the advice industry, and he came up with something. He said, why don't you, at the end of the review meeting, ask the client every time and say, what part of today's meeting did you find of most value? And you know what? We don't ask, do we? We sit there and go through all this stuff, and often the last thing they do is sign a form, or here's your binding nomination. So actually, we should be doing that. Like, we should be asking them, what part of today's hour and a half or hour or 40 minutes did you actually get the most out of? So the next time we can flip that around and say, hey, I know you really enjoyed this presentation, or you do like looking at the investments, or whatever they like, because we go in with a bit of an assumption, hey, this is what we're going to talk about. Little things like that can change your model pretty quickly. Exactly.
And it just delivers greater value to the client, because you're listening to them, and it's just a great way to ensure that the client remains engaged with their advice.
Absolutely. And we can sort of get stuck in our routines. I've got some younger advisors coming through, which is great. And I keep saying to them, don't assume. I might have been doing this for 20 years, but don't assume I know all the answers. Challenge it and saying, hey, what about this? Because we can just get caught in habits. And it's not bad, but try to flip it around and look at something differently.
It's a good point, because I've always, especially for new staff, I always try to, even if they haven't come from the industry, try to get them to give feedback and basically asking the question, why do you do it that way? And I try to ensure that no one ever answers because we've always done it that way. And I also don't want anyone to say, I do it this way. Right? And that forms part of that culture process about making sure that everyone is talking from the same kind of process, but then we're challenging that process all the time.
That's really important. From an investment point of view as well, not like your business model, you've challenged the industry status quo, and from an investment point of view, you have as well in the early days particularly. So tell me a bit about that journey and how you now manage portfolios or primarily.
So as I mentioned, that the investment piece and the way we gave advice was one of the catalysts for setting up strategy first. We started talking to Dimensional, given their evidence, given the research and the evidence-based investing process, and it really struck a chord with us. And also tying into that, how we asset allocate. It's obviously a key part of the outcome a client gets from their portfolio. Obviously understanding what the client's risk profile is and testing that, but then not just taking their response from a questionnaire and using that as a guide, because someone who's 30 like yourself, for example, you might on average you'll come out as average, right? So which would often correlate to a balanced risk profile. But if someone is 30, we know that they can't touch their super for 30 years.
Yeah.
So if you think about it from a point-to-point perspective, there's no volatility, so take all risk with that part of your capital.
Yeah.
So we understand the client's risk profile, and then we build some asset allocations around that.
Yeah.
But then you've got to build that, you've got to effectively implement that asset allocation. And there are many ways to do that.
Yeah.
You can be a stock picker and a bond picker. You can be like a lot of Australians, I think, they'll buy the 4 banks or so, Woolies and BHP, and then buy some term deposits.
Yeah.
When we look at investing, a couple of things that I think most of us take for granted, or hopefully should do, is that there is a direct negative correlation between the cost of portfolio management and the expected net return the client gets.
Yep.
Right? As in, the higher the cost,
Yep.
the lower the expected return, all things being equal.
Yep.
When you then take into account tax and you think about active management, is typically more tax inefficient, then you get, in most cases, a worse net of fee after tax return for the client.
Yeah.
I remember 20 odd years ago looking at some data at the top Aussie equity managers compared to, say, the index. Now, whilst there were some outperformers before tax, when you look at the composition of their annualized distributions, which were well above the dividend yield for the Aussie market, because it incorporated a lot of capital gains, you think, well, the after-tax return for the client, unless you're in a tax-free environment, is going to be a lot less. And for a taxed client, whether it be in accumulation super or in their own name, they can't control those realised capital gains. Okay, so, we know that those fund managers in particular are tax agnostic. They don't care. Because you don't publish after-tax returns. So, we start on the premise that low cost, tax efficiency is a key part to deliver a high expected return. And then you take another step and say, well, looking at the research, for example, that Dimensional and others have put out there, so there are risks in markets that, reliably and cost effectively can generate higher expected returns. It's not beta, it's not through active management or being a better manager. It's simple things like, small companies are riskier than large companies. And therefore, where that risk and return correlates, or expected return, you should get a higher expected return by buying small companies compared to large. But you don't put all of your equities into small companies, you balance it. The same thing with value versus growth companies, emerging markets versus developed markets, credit versus term deposits, for example. And then being careful about how you structure those portfolios. And so the outcome you get for clients is a very diversified exposure to any market, which means that the individual components that do really, really well or really, really poorly get diluted out. And you're getting that proper market exposure. So the benefits I get is a bit more reliability in terms of the expected outcomes they get. They're not hopefully going to be surprised, and therefore hopefully we don't have to apologize. But the other key point, if you think look at a lot of the Dalbar research out of the US, when you look at the market S&P 500, for example, compared to what the underlying mutual fund investor gets after fees and costs and everything else, the difference is staggering and not in the investor's favor. And part of the reason being, and I think part of the benefit of this is that, investors will typically flip from, bottom performer to top performer, bottom performer to top performer. And so they're typically buying expensive funds at the wrong time after they've delivered that strong outperformance. And that just generates a lot of friction, a lot of costs, taxes, and then they're buying a fund that's potentially going to underperform in the future. And so they get this really poor outcome. By having a more robust process and messaging that to the client, they're going to be stickier. Okay, they're going to remain in those funds even when value underperforms, as it has for a long period of time. Because they might not be happy with it, but they understand it better. And so therefore they're less likely to sell when values underperformed.
I mean, it's an approach. You've seen it now working for clients for over 20 years, and so have I. But I think when, particularly when you have clients or even staff sort of trying to get their head around it, at the end of the day, you can only sit there and say, this is the absolute best thing for the client. And I'll keep looking for the best thing for the client, but I just haven't been able to find anything better. And there's other advisors who sort of maybe mock it a bit or whatever. And you think, well, hang on a second, show me the data for 20 years and tell me that you can honestly sit here with hand on your heart and tell me that you're not going to have to change something in 2 or 3 years' time because the Magellans of the world get it wrong. And it's not to say they're not smart people or these investment managers, but it just doesn't lead to the best outcome for your clients. Now, there's no data that backs up the other approach. There just isn't any. There's, realms and realms of paper saying this evidence-based approach really works for your clients. And also, when you're talking about, it gives them a great client experience. You're leading them, you're educating them about things that they probably didn't know about before they met you, and you're giving them the best possible chance of success. Now, in my view, and there's some advisors who might not like this when they listen and say, if they're doing it the other way, they're probably serving themselves before their clients because they're interested in that, or they think that's what they like doing, and that's cool. But like, don't upset, don't cost your clients 3 or 4% for the next 20 years just because you've got a bit of an ego.
Yeah, exactly right. It's fundamentally that ego issue that puts, I guess, too many advisors in the way.
Yeah.
Right. I got an absolute fascination for a lot of different scientific podcasts. Yeah. Particularly, health, physical type things. Yeah. And a lot of the great podcasters, they're scientists, and they say there might be a relationship, there might be a correlation, but show me the data that is causative.
Yes. Yeah.
Right. And it's the same thing here.
Yeah.
A fund manager X has shown 5 years of outperformance. Yeah. Show me the data that correlates, it gives us a causative correlation, and therefore be able to extrapolate why that should be the case in the future.
Yeah. Yeah, recently, I don't know if you caught it a few weeks ago, Ken French spoke, and he's had this stat a lot, but he talks about to actually be able to prove that data is going to be repeatable, you need 64 years of data for that outperformance. So he said 2 or 3 years is nothing. It's not enough data. Forget about it. Stop pretending that's something that's going to be reliable. But I think for advisors to understand that as well, particularly, they might be thinking about changing it because this evidence-based approach has become a lot more popular today than it was 20 years ago. 20 years ago, there was almost no one using it. And I remember one of the only reasons I met with Dimension was because they didn't pay commissions and we were commission-free. So I thought, that sounds really interesting. Why haven't they paid commissions for let alone then? But they'd started in 1982. So it's a long time of never paying commissions and never closing a fund. Yeah. So to me, that was interesting. Going, well, hang on a second, that sounds like a pretty good approach. Because I don't want to have to say sorry to clients. Yeah. I've done that in the GFC, and not because we were using the wrong approach, but I was part of a big accounting group, and there were some clients who had some bad outcomes, not because of my advice, but just through other things that perhaps they got exposed to throughout other people in the group. Yeah. And you don't want to sit there and say sorry to someone. So it's just not a good feeling.
I mean, we at the previous firm, we used to get the fund managers to come in, like even the top managers of top funds, and with all due respect to them, they're very smart people, but they would tell us a story as to how they are a great stock picker, bond picker. Yeah. And they'll give you the 3 kind of notional top, examples that have done really well. The one that they throw the one in that didn't do too well to show that they're not infallible. But if you line up all these managers, they're all going to give you a credible story as to why they can pick value or growth stocks better than everyone else, and they should outperform the market.
It's their job to tell you they're the best. Yeah.
But then, why do we always have to apologise for them? They underperform when they're not expected to. Yeah. And they underperform by more than they should. And if you're lucky, you'll get the outperformance. Yeah. But it's just based on luck.
That's right. A lot of people talking recently about Magellan, and again, very smart guy, very, very, very smart person, and it's done very well. But when people ask me about it, that's very common. It's just that he was famous. I could go into the Lonsec or Morningstar report and give you 50 managers that have outperformed in the last quarter. Yeah. And it's just like him, they're really smart. He just happened to be really, very prominent. But that's just really common. So don't think this is a one-off. Your odds of success are so slim by paying a manager 135 basis points and hoping that they outperform. It's just it'd be great if it worked, but it just doesn't. Yeah.
And it's funny. I've spoken to some advisors who take a very low cost diversified type approach with the evidence based with the index, and then we'll throw in someone like a Magellan. Yeah. On what basis do you expect that they will outperform? Yeah. And apart from historical performance, it's difficult to come up with a robust answer as to why you think they will. Yeah,
that's right. So again, what you sort of look at that and go, they're sitting on the fence a bit, but why? Because they feel like the clients want that. My question is, I don't think I've yet ever had a client who's come in and said, I want to pick funds, I want to pick stocks. Yeah. They'll do sort of what we, most of the time, what we advise to do. There's the odd one who's got a bit of interest and knowledge, and they've got some, they do have a bit of knowledge around all that, and they might be swayed previous experience or other advisors. But the majority of clients, they don't know that, and they're asking. That's why they're coming to us to advise them.
Well, I can tell you, when we started almost 17 years ago, a lot of our clients came across with us, which is fantastic. And they obviously brought along the portfolios that we were managing at the old firm.
Yeah.
We didn't know better.
Yeah.
And I can tell you that say between David and myself, we looked at a couple of those managers who, had a, say, deep value approach and thought, they may continue to do well.
Yeah.
Clients may want to punt.
Yes.
Right? Something that's a bit more, active than DFA or index and so on. And what we realized was that clients don't care. As in, they care about their money, but they don't care about the approach as long as they believe that we're working in their best interests.
Absolutely. Yeah.
It was us who didn't want to let go.
Yeah.
Right?
So true,
We thought that we needed to be potentially in some way more active or have those more exciting type investment options.
Yeah, absolutely.
But clients don't care.
Yeah, very true. All right, so it's been really informative so far, so thanks so much. But one of the questions again I'd like to ask is, if you could change one thing in the advice industry, what would it be?
That's a really good question. There are so many ways you could look at it, saying, is it vertical integration and avoiding all those conflicts, so that should drive us to be more of a profession and therefore alleviate some of those compliance obligations. It could be the silver bullet technology solution that allows us to produce SOAs today that are real value added and make that process a lot easier. People in the industry understanding the spirit of the law in which we operate and not just looking at the regulations, for example, as a negative ticker box process. Then people, and even with the code of ethics, for example, for us, we felt that it codified a lot of what we had been doing. But as we know, the law doesn't try to just get to the lightest shade of grey. When it sees a problem, the government will introduce laws that make it basically like a sledgehammer for a nail. So if we can create a higher level of ethical enlightenment in the industry, with things like vertical integration, all those kind of things, I think that'll lead us to be a profession more trusted, and hopefully it'll then allow us to get all those other benefits, which might be a better engagement process. So instead of having to go to a 30-year-old and basically explore all of their retirement planning and everything else, we can focus on proper agile advice, which is about, okay, what's relevant to you today, and not need to, unless it is related, have to consider things like which are 30 years out.
Yeah, much more practical sort of solution. I think we're getting closer to that.
Yeah,
absolutely. Well, there's been a lot we've talked about today, the key issues, technology using, which is fantastic, and you've been at the forefront for a long time in the industry. So again, I'm really sure that people listening will get a lot out of hearing your experience and what you're trying to do in the business and where you're taking it. Anything else you want to add before we wrap up?
Oh, look, I think, I guess I just wanted to give you credit for doing this in the first place. And for the reason being is that if you think back over the years, you've been in the industry for a long time, like I have, it used to be the case that advisors would be, I'm not going to talk to you. I've been the beneficiary of a lot more collaboration with other great advisors. A lot of our tech stack, comes from a collaboration with, another advisor local to me, and it's just been great to share these ideas. And I think what I'm experiencing, with groups like the Mentor and the advisor cohort within and some other key groups, is at the pointy end of the industry is actually trying to work together to get further ahead. And that's just fantastic, and a credit to you, Nigel.
Well, you've definitely been part of it. I think so. I think advisors are now realising that they've got a role to lead the industry. And guys like you who've built great businesses, there's quite a few around it, and really trying to help each other. We're not competing with each other. We're trying to actually help the industry go forward, so that people coming through behind us have something to look forward to.
And clients just get a better outcome.
Brilliant. Well, Patrick, thanks so much for your time today. I have all your details on there. We don't want you to be, bugged by thousands, but I hope you're open to people maybe reaching out and saying, hey, I learned a lot from you today, and they might contact you. But thanks so much.
Pleasure. Thanks, Nigel.
You've been listening to The Future Financial Advisor. So if you've been enjoying the show, please make sure to share it with your network and leave a review on your favourite listening platform. Or if you've got some ideas or thoughts or would like to come on as a guest or know someone who would be a great guest, then please let me know. To learn more about CNTM, just go to our website, cntm.com.au, or look me up on LinkedIn. Look forward to speaking with you, and see you on the next episode.